Hello, and welcome to Fininvest Niger. My name is Tom Princeville. I'm a certified securities and investment specialist. Someone said that an expert is an individual who has made all the mistakes he needs to make in a narrow field of human endeavor and probably or possibly had learned from those mistakes. Though I think I've made virtually all the mistakes I could make in the area of investing, but I don't still classify myself as an expert. That's just by the way. In actual sense, I want to talk about common mistakes stock investors make and how to avoid them. Common mistakes that investors find themselves making, and how those mistakes could be avoided. In my earlier years as an investor, I made so many mistakes. As I'm currently speaking, I don't think there's any mistake I've not really made in the course of my about 20 years of investment career. And hopefully, I think I've learned so much from them, and I've like vowed never to repeat those mistakes again. And I want to believe you also, as a beginner in the field, will learn from this presentation and see how you could avoid these mistakes as you progress in your investment journey. Number one is investing without a plan. Investing without a plan. Someone said if you fail to plan, you're actually planning to fail. And this particular maxim is equally applicable in the field of investing. So many investors, they buy stock without a clear-cut goal or objective. There's no time horizon, and they lack the risk tolerance. So this often leads to the kind of impulsive decisions. They make impulsive decisions because they have no clear-cut objective, they have no clear-cut goal or plan in the first instance, and they tend to make decisions based on impulse without logically thinking through what they do in the markets. So how do we avoid this particular mistake? In this case, you need to define your investment objectives very, very clear. You define it clearly, let it be clear cut and fully understood by you. In that case, you could consider either you want to go for growth, or you want to go for income, or you want to consider capital appreciation. There should be a guiding plan that will help to keep you focused as an investor. And then you consider your time frame. Are you a long-term investor or a short-term player in the market? And you also define what level of risk you are willing to accept as an investor in the market. The market is inherently risky, so you have to determine the level of risk you will accept, you will tolerate in the market, or else you will not be able to endure when volatility comes in. And number two is trying to time the market. Trying to time the market. That's in other words, attempting to buy at the bottom and sell at the very top. It usually results in missed opportunities and poor returns. Nobody can actually, buy a stock when it is at the very bottom and sell precisely when it is at the very top. Is humanly impossible. So don't even try or attempt it, or else you may end up missing, important opportunities of buying or selling stocks in the market that will be profitable or that will increase your returns at the end of the day. So how do we avoid this particular mistake? You focus on long-term investing, and you consider strategies such as what is called dollar cost averaging. So in this case, when the stock goes down, in price, you buy because you are buying at a lower price. So when it eventually goes up, you make profit as a result. So you buy as the stock keeps on going, keeps on dropping, you are buying as a result. As it keeps on going, and you are buying. And when it eventually goes up, you end up making profit. Don't just target the top to sell or target the bottom to buy. I think it's humanly not feasible. Number three is letting emotions drive decisions. Letting emotions drive decisions. Essentially, human beings are not rational or logical when it comes to investing, just like it's applicable to other spheres of life also. So in this case, human beings tend to make decisions that are, kind of governed or controlled or motivated by emotions. So fear during market downturn, and greed during market rallies often cause investors to buy high and sell low. When the market is high, greed comes in, people want to participate in the rally, you will end up buying high. And of course, the market will not keep on, going on, climbing indefinitely. Trees don't grow to the sky. Eventually, the market will self-correct. And when you buy high and the market self-correct, you end up selling low and you lose your money as a result. So how do you avoid this particular mistake of letting emotions to drive your decision of buying or selling in a market? So in this case, you stick to your investment plan and rely on company fundamentals rather than short-term market noise. In the short run, the market is like a voting machine, and in the long run, the market is a weighing machine. So do not allow your investment decisions to be controlled by emotion, but rather be controlled by logic, by focusing essentially on the company's fundamental. Number four is lack of diversification. Lack of diversification. So you discover that putting too much money into one stock or one particular sector tends to increase your risk as an investor. You don't do that. You don't really do that, okay? Because the market is inherently risky. It isn't advisable that you put too much money in a single stock or in a few number of stocks. It's advisable that you invest with you know that long-term focus, and you also diversify across industries, across sectors, and sometimes across geographies. You diversify even outside your home country. Maybe as a Nigerian, you could choose to buy stocks in the US. You could buy any of those blue chip stocks in the US. By so doing, you are diversifying across geographies. You are going beyond your country, and this will reduce the volatility of the portfolio, and by so doing, will reduce the overall risk that comes with portfolio concentration. Number six is number five here is ignoring fundamentals. You ignore fundamentals. Buying stocks based on tips, based on hype, or social media trends without analysis can lead to losses. Somebody can just come up on YouTube or wherever and tell you, buy this and buy that. And these companies sometimes are loss-making companies. And if you listen to such advice, you may end up regretting at the end of the day. So don't follow tips. Okay, follow company, buy based on company, fundamentals. Don't never ever ignore fundamentals when it comes to investing, and don't follow hot tips. It's not always the best. So how do you avoid this particular mistake? You analyze financial statements, and then you also look at earning growths of the company, the debts level, and you also analyze companies' competitive advantages. That is how you avoid this kind of mistake. You buy stocks based on thorough research and analysis, and once you analyze thoroughly, you discover that you would end up taking fundamental into proper consideration. And number six is overtrading. Overtrading is a common mistake that people tend to make in the market. So, frequent buying, and selling, increase transaction cost and taxes. And these two factors could, reduce your overall returns at the end of the day. The more you buy, the more you are charged transaction cost. And this fee accumulating over a period of time will end up eating into your profit. So don't overtrade. Hold your position for a long time so that you can realize enough capital gain. Don't just buy today, sell tomorrow, buy the next day and sell the following. No, you allow your investment to actually, you give it time to grow. And then by so doing, you have a better result at the end of the day. So how do you avoid this mistake of overtrading? In this case, you kind of invest with a long time objective. You invest with a long time mindset, and you trade only when there is a strong fundamental reason for you to trade. Don't just buy because of emotion, or maybe you want to like buy or sell because of the market condition. No, you must make decisions based on clear cut fundamentals governed by the company's fundamentals. If the fundamental deteriorates, then you are free to sell. Okay, this is how to avoid over trading. Number seven is chasing past performance. Chasing past performance. There's always a caution when it comes to investing, and the statement there is that past performance is not a guarantee of future returns. When people call me, they ask me, what stock do I buy? What fund do I invest in? I tell them, or tell the individual that the stock or the fund is doing well today, doesn't really guarantee that it will continue to perform well in the future. Fundamentals may change. All right, and so there's no guarantee that a hot stock today will remain hot tomorrow or forever. No, the market always fluctuates, and fundamentals equally tend to fluctuate, sometimes. And so don't chase, past performance. How do you avoid this particular mistake? You focus on valuation and future growth, potential rather than on past price movement. Forget about the past. The past is past. Okay, and let the future performance of the stock govern your desire or decision to either keep on investing in that particular company or to liquidate your position, from that company. Number 8 is neglecting risk management. Neglecting risk management. This will really cost you a lot. Failing to access, downside risks can lead to large losses. When you are buying a stock, don't just concentrate on how much am I going to make out of it. Think of how much am I willing to lose in this particular investment. Maybe you bought a stock for 10 naira. You ask yourself, if this stock falls to 7 or 6 naira, will I still be willing to hold the position? Don't just keep on imagining, oh, I'm buying at 10, I will end up selling at 20 or 30. Sometimes the stock may drop. Okay, and so you have to consider risk management, because there's that inherent fluctuation in the market, either based on fundamental or based on sentiment. It always happens. So how do you avoid this particular mistake? You focus on what is called position sizing. In other words, if you have let's say 100,000 to invest, or a million naira to invest, I'm investing this money in 10 stocks. You may divide the money into 10 places. You can invest, let's say, 100,000 per position in 10 places, or 10,000 per stock per position in 10 places. By so doing, you can properly kind of apply risk management. So in case any of them drops, it will not so much adversely affect your overall portfolio. And you also regularly review your position. You carry out regular review to know precisely what to retain in the portfolio or what to sell based on fundamental analysis. Number 9 here is not reinvesting dividends, not reinvesting this particular point essentially goes against dividend investing. We are expected to invest and accumulate dividends regularly to support your lifestyle, but it's okay to crave for regular dividend. But as a long-term investor, we also advise that if you don't really need the money, it's good to you reinvest your dividends. You reinvest the dividends as well as to be able to grow your portfolio, grow your positions in the stocks you bought over time. It might be difficult, but it's a decision you could make if you really want to have an outsized returns after a number of years. And so spending dividends instead of reinvesting them reduces the power of compounding. You don't invest for dividend, you keep on spending it without investing it. It reduces the capacity of your portfolio of stocks to compound over time. So how do you avoid this particular mistake? You reinvest dividends, especially during the wealth building stage. At the early stage, you are building your wealth. Don't just consume your dividends. Keep on investing it. At the end of it all, you discover that you have something sizable at the end of the day. The number 10 is lack of patience. Lack of patience. An investor must have patience. You must be patient. You must have patience in the market, you know, and patience with yourself as well. And so expecting quick profits, often results in abandoning good investment too early. You want to make money quick, 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 fast, fast money. You don't do that as an investor. Patience is very, very important. Somebody like Warren Buffett, the world's, richest investor, started investing at the age of 13 and now is in his 90s. Look at the level of, patience all through the years, patiently investing and then accumulating wealth as a result. So patience is very, very important as an investor. It's a virtue you must learn to cultivate. So how do you avoid this? You give quality investment time to grow and allow compounding or compound interest to work. Albert Einstein said that compound interest is the eighth wonder of the world. If you don't give your investment enough time to grow, you will not be able to achieve optimal returns in the market. Give it time. All right. There was a video I made the video in my channel about returns on stocks for the past 10 years, thereabout. Discovered that an investment of ₦1 million yielded about 60 million naira after 10 years. So the more you allow your investment to, the more the time frame is elongated, all things being equal, the greater the returns you are going to accumulate as an investor. So patience is very, very important. Please subscribe to this channel, like this video, and share the video as well, because I want to reach out to 1 million Nigerians with this message of investing. In the US, as statistics indicates, over 40% of the population, adult population, is involved in the stock market. But in Nigeria here, the figure is less than 4%. Less than 4% in Nigeria and over 40% in the US because of lack of awareness of the inherent wealth building tendency in the market. Please share this video so that many people will get to hear this content I'm passing across to us, considering my objective in mind. I'm relying upon you complying with my plea to subscribe and share this video. It will do me a ton of good, reaching out to as much as 1 million Nigerians with this important message of investing in the stock market.